Hello, this is Skip Kapoor from the channel Passive Income from Equities. I'm a retired investor living primarily off of income from equities. So today we will be discussing SPYT, an ETF that is based on the S&P 500, my favorite index. I consider this to be a quality, high yield, tax efficient ETF, and I will walk you through this ETF and why I have come to the conclusion that I just stated. Let's cover some basic information on SPYT. Its formal name is Defiance S&P 500 Income Target ETF. Defiance is the company that provides it, and it has a slew of ETFs with a very wide range of strategies, some of which I like, some of which I don't. SPYT is probably the one that I like the most in terms of strategy. Its objective, it has two objectives. A primary objective is income. A secondary objective is to try to have exposure to the underlying asset, which is the S&P 500. Both of these literally mirror my own strategy at this phase of my life as a retired person who's living primarily off of income from equities. So this strategy of this ETF is the strategy of my entire portfolio. So that is something I feel very, very comfortable with. I'm going to say this a few times, but always remember that when you go for higher income, which is what I'm doing, you have to be prepared for some slight underperformance against the S&P 500. I will show data a little bit later on regarding this ETF, and you will see that that is also true in the case of SPYT. The strategy, which I consider a bit unique when compared to other high yield covered call type ETFs, is that this is the only ETF that I know of that sells a covered call spread on the S&P 500 index, and it sells it daily, which is another aspect of the strategy that I consider advantageous, because the longer you sell the call spread, the more you're giving, or rather the longer the duration of your call, the further away the strike date is away from the date you sold the call, the higher the probability that the call will slip away from you. So I like daily calls over weekly calls over monthly calls. And so it's basically a covered call spread on a daily basis. A quote from the prospectus that I think encapsulates the strategy rather well, and that the fund will not participate in the first 0 to 0.5% or 50 basis points of any daily gains in the index. And with that one statement, they're pretty much telling you their tactic on how they're doing the covered call spread. The call that they're selling is probably as close to at the money as possible, and the call that they're buying is probably within 50 basis points. It's a small fund as of August 11th, the date I'm talking. It only had about 50 million in assets. Typically, I would expect an ETF to be in the 250 to 500 million range to where it can start accumulating some benefits of efficiency, etc., that it can pass on to shareholders. So still got a ways to go. It's quite new, not even 5 months old. Its inception date was March 27th of 2024. Its yield, which is again its primary investment objective, is around 20%. The distributions are monthly and it's holding. I bought it very close to inception date, and it's definitely held. The expense ratio is about 94 basis points, which is almost double of what I would consider reasonable for a fund with a strategy such as this. All the data that I'll be sharing is as of close of business on Friday, August the 9th, 2024. Some more basic information on SPYT. Defiance uses an advisor called tidal investments. And as best as I can make out, they're a white label ETF provider. And I think what that means is Tidal is providing all the back office support for the ETF, including reporting to the SEC, all other regulatory filings, and so on and so forth on behalf of Defiance. So they charge a fee for that. And then Defiance is then using a sub-advisor that actually does the execution of the strategy. And both of these components, the advisor and the sub-advisor, clearly explain the higher fee structure, right? Because you've got three people involved. You've got Defiance, Tidal, and Ziga. And the only good news, if any, in this is that Jay Pestricelli, who's with Ziga, is the key architect of both the strategy and the tactics in terms of how they execute it on a daily basis. And if you see any of the interviews of him on YouTube and other channels, you'll see that he is a very knowledgeable person, a very experienced person, and a key asset for this ETF. Let's cover how a covered call spread strategy works. And I've built this table that will address the four possible scenarios, which are really the only outcomes, as far as I'm concerned, that is possible in such a strategy. So as a background, all the option trading is done on the SPX, which is the S&P 500 index. And these are cash settled options. So there's no underlying asset like IVV or stocks that are actually transferred upon option expiry. The settlement is based on whether the trade went for you or against you. So it's all cash settled. So in scenario one, I'm basically walking you through the basic trade, which is, let's assume, this in the case of this example, that the SPX was at 100 at the time that you placed the call spread. So what they do is they sell a call as close to the money as possible. So in this example, I'm using 101, and I'm showing that they receive a premium of 50 cents. They buy a call always above the strike price at which they sold the call. So in this example, I'm using 102, and because it's further away from their current price, the premium that you pay will be less than the premium that you received for selling the 101 call. So the 102 call that you bought will cost you less. In this example, 25 cents. So the net premium that you're getting to keep is 25 cents. Okay, the difference between the 50 cents you got for selling the call and the 25 cents that you paid to buy the call. So one scenario is that the SPX ends at 100. This is frankly the best possible outcome for the strategy because you get to keep the net premium of 25 cents. And essentially you're outperforming SPY because anybody holding SPY, which is the S&P 500 ETF, is not receiving the 25 cents, but you are. Scenario two, the SPX ends at 101. And remember, these are daily trades. So just keep that in mind. So at 101, what you're doing is you get to keep the net premium of 25 cents. And again, you have outperformed the SPY. And the reason is that when you sold the call, it would only have cost you if the SPX went above 101. It did not. So that's why, just like in the case of at 100, at 101, you get to keep the net premium. The advantage in scenario two over scenario one is that your next day call is going to be starting with a price of 101 as your base price versus 100, meaning your asset, the underlying asset that you own has increased in value. So far so good. What that means is that for no movement or slight movement, you're outperforming the SPY. In scenario three, it ends at 102. And in this case, what happens is you are going to pay on the call that you sold. You sold a call at 101. You're going to have to make up the difference between 101 and 2. So and even worse, you get no benefit from the call that you bought because that only pays above 102. So here you're going to probably underperform the SPY. In scenario 4, the last possible option is that you go way above the 102 bought call to 105. So what happens is you're going to pay on the sold call, the difference between the 101 and 105. You're going to receive income on the bought call, the difference between 105 and 102, and you're going to slightly underperform the SPY because if you owned the SPY, you would have gotten the gain all the way from 100 to 105. So that's basically how a covered call strategy works. And the differentiation between a spread strategy and just a regular covered call strategy is that in a covered call strategy, you're not buying the call. In this spread strategy, you are. So the thing to keep in mind is that markets rise over the long term, obviously, but this is a piece that you may or may not be fully aware of. When they do rise, they do so in sudden spurts. It's very rare that it's gradual over a long period of time. So most market gains come over a few days and in very large spurts. I've actually done a video on my channel called Timing the Market versus Time in the Market. And it is because of this exact precise reason, i.e. scenario 4, that in the long term, SPY-T in total return terms will slightly underperform SPY, the S&P 500 index. Now that we understand how a covered call spread strategy works, let's look at SPY-T's performance to date. And obviously you need to use the S&P 500 represented by SPY, the ETF that owns the S&P 500 as the benchmark. So comparing the two, a couple of things, right? One is there's not just simply not enough data because this this ETF only came into existence in March of this year. So it's not even 5 months of data. So that's one important thing. So in my view, you need to have at least 2, 3, maybe even 5 years of data to really be able to, create a genuine hypothesis. However, early indications are positive. The annualized uh, total return performance is about 172 basis points, meaning that if you owned the S&P 500, you would have outperformed SPYT by 172 basis points on an annualized basis, which is in line with my expectation that when you invest in these high income covered call strategy based ETFs, you're going to pay a cost, and the cost will probably be a drag of between 50 basis points to 200 basis points annualized over the long term. And that's the price you pay for getting kind of guaranteed income that you can live off of. So that's the trade-off that uh, people like me make. And the data is demonstrating that my hypothesis is correct. Sortino is essentially the Sharpe ratio, but it's basically risk-adjusted return. But what Sortino does is it only looks at risk-adjusted returns for negative price movements because that is what causes investors to make emotional decisions. So the Sortino higher Sortino is better. So the SPY Sortino ratio is a bit higher than SPYT, 1.55 over 1.4. But again, just keep in mind there's only 5 months worth of data. The standard deviation for SPYT is lower by almost 180 basis points or so, and that's to be expected. That's a normal outcome for income-oriented investments because you get income, it tends to dampen volatility a little bit, and lower standard deviation is always better than higher standard deviation. Let's take a look at the holdings of SPYT. One of the most important things and the aspect that I like a lot is the fact that its underlying holding is IVV. So IVV is the S&P 500 ETF from iShares. Is very cost effective. I think it's only 3 basis points per year in terms of annual expenses. And that forms the bulk of the assets. And this is important because the option trades are cash settled, the holding of IVV moves uh, just as the S&P 500 moves. So that's a very important thing to keep in mind. And I like that aspect. So that's about 99.65% on the day that I looked at it. There is some cash that they have that was about 42 basis points. And then the difference between the sold call and the bought call on that day was 11 basis points. So when you sum it up, it's not quite 100%, but it's close enough. But that's what they were reporting. And it definitely made a kind of made sense to me. Now remember, sold calls are a short position. Sold calls will result in, from a cash perspective, it's a positive, but from a holdings perspective, meaning how it's reported, it's always shown as a short position. So it's net negative, even though you're actually netting cash at the end of the day. There are 4 components to the return from SPYT. You'll get capital gains, which is the underlying movement on IVV over time. You'll get dividends from IVV itself. You'll get the net option premium on a daily basis. On some days, you'll actually get to keep it. On other days, it'll actually cost you if the trade goes against you. And then the little bit of cash that you have, it's going to generate interest, and that interest will also accrue to the ETF, and from there, hopefully to you as the investor. One of the most important aspects of investing in these alternative income strategies, the passive income approach, if you will, is that you don't want distributions where they're simply returning your capital. There's no point in getting high yield and the bulk of it coming back from principal. So far, it looks like the distributions seem to be non-destructive return of capital, which is a positive thing. And I'll walk you through the data. So this is data that they have reported. And for 4 months of distributions, if you annualize them, it gives a yield of around 20%. So there's a 20% yield on whatever you invest. Of that, the return of capital, the portion that is going to be marked as that is about 81%. So what that means is that if I got $100 in distribution, 80% of it, or 81.51% to be precise, I would not be reporting on my income tax return for this year. But what it would do is lower my cost basis so that when I did sell it, I would pay a higher tax at that time. In my case, since I don't intend to ever sell it, that's really irrelevant. So basically the way to look at that from a tax situation is as follows. When you get the income, you're reporting about a fifth of it as ordinary income. Second, at the very minimum, you're deferring taxes because when you do sell it, you are paying for it, but you're paying for it in terms of capital gains. And third, if you don't sell it, there's no tax implications, or if there is, it's to the people who will, I guess, inherit your estate. The monthly distributions seem to have a very low variation, i.e., they are predictable. That's a very, very good thing. And the way you know that return of capital is non-destructive is if the net asset value remains the same or increases, right? So far, the 52-week spread is rather narrow. It's around 13% so far. And I'm probably a bit underwater in it, but not enough to worry. It's with 13% variation on an ETF like this is quite frankly more than acceptable. So if I were to summarize, the distribution looks quite high at 20%. It looks predictable. There's not much variation. and it looks like it's non-destructive return of capital. All positive things and all what I was counting on when I made the investment. So the thesis is holding so far. If I were to map SPYT to differing market scenarios on days, again, remember the call spread is sold on a daily basis. So I'm going to use that as the timeline for the example. So on a day that the S&P does not increase, simply treads water, SPYT will perform better because of the net income premium that you have received. On a day that the market goes down, you should perform better for exactly the same reason. You've got income, and that income subsidizes some of the decline. So on days where you tread water or have negative returns, you're going to outperform the S&P 500. On days where there's movement upwards but very slight, you should match performance, if not beat performance, right? Because you'll have, if you remember the example I gave you on the scenarios, if it went from 100 to 101 and you sold the call at 101, not only do you get to keep the premium, but you're not having to pay out on the call that you sold. So you're actually going to either match performance or even beat performance. In the last scenario, you're going to underperform. When there's very rapid movements on a certain day, you're going to either slightly underperform or massively underperform depending on how rapid the move is and how high it is. In the long term, just so that there's no confusion, SPYT will underperform SPY in total return terms, just like I showed you in the earlier slide about the year-to-date returns over the last 4.5 months, where there's been about 178 basis points in underperformance. That is to be expected. And the reason for that is, and I'm going to keep repeating it as many times as necessary, that when the market increases, it does so in sudden spurts. So for example, over a 20-year period, you miss 10 days and you end up missing a huge portion of the benefits of investing in equity markets. Let's cover some additional facts about SPYT, things that will help bring big picture perspective. The first thing, which I like a lot, is that there's no active stock selection. The strategy, the covered call spread strategy, or to be even more specific, the daily covered call spread strategy is based on the S&P 500, which I consider to be the best index around. It's 500 companies, diversified, and to bring up something that a lot of people don't know, every company in the S&P 500 must have positive income when you total up the last 4 reported quarters. So it's my index of choice. So there's no active stock selection. The second thing is there's no use of leverage. Now, obviously, when you are selling and buying covered calls by technical definition, that is leverage. But when I say leverage, no use of leverage, what I mean is that the notional, that is the amount invested, does not exceed 100% of the assets under management, meaning that when the calls are sold and bought, they are not on any portion larger than 100% of the AUM. So you will not be taking chances with leverage. I personally will never buy any product that uses raw leverage. The third thing that's kind of important is that the growth is not capped. So even if on a certain day, the bought and sold call, the net of it goes against the ETF, and yes, they have to cash settle the difference. The underlying growth is not capped. The ETF owns IVV, which is iShares product for the S&P 500, and so you get to participate in that growth. The next thing, and probably the last thing, is that the advisor and sub-advisor used by Defiance. It's important that you understand that in addition to Defiance, there are two other companies, Title and Ziga. And I view this on net as a somewhat positive fact. On one side, you have better access to talent because Ziga and the people that Ziga brings with them, like Jay Pestrichelli and others, are clear specialists when it comes to covered calls and the use of covered calls to generate income and not give up too much on total return terms. On the other hand, there's obviously increased organizational complexity. Like any of us who have worked in large corporations know that the moment you have not one organization, not two, but three, there's just more friction cost, right? You have to have more meetings, more talking, and so on and so forth. I don't think that's a particularly big issue in this case because Defiance is simply providing the marketing umbrella. Title is providing the white label ETF structure, does all the reporting, etc. And Ziga is focused on the execution of the actual strategy. So I don't know that it's terribly inefficient, but it's something to keep in mind. And obviously, this management structure, to some extent, explains the high fee structure. It's a very high fee structure. As I mentioned before, it's about twice what I would have wanted it to be. So overall, on net, I like the picture that this particular slide depicts, and I see it as a significant net positive for people considering this ETF for their portfolio. So here's my summary on SPYT. One is that the underlying holding, which makes up a very high proportion of the AUM, will move with the S&P 500. That's a good thing. There is a marginal non-material difference in total return versus the S&P 500. So right now it's underperforming at a run rate of about 178 basis points. I expect that to be the case over the long term. And when I say long term, I'm typically thinking in terms of 5 years plus, and that difference could be in the range of 50 basis points per year to as high as 200 basis points per year. And what you're getting is the yield, which is the primary reason to buy this ETF. So the call spread strategy allows for participation on high return days. And what I mean by that is because you have bought a call in addition to having sold a call, and hopefully you understood the examples I gave you, when you have those high rapid moves, the trade, the sold call trade doesn't completely undo the cumulative effects of all the good days that you've had. So that's a good thing. I like the strategy. The expense ratio is quite high, and I think it's a tough weight to carry. I own it, and I'm not because I think it's going to somehow be able to keep paying out the 20% yield. Quite frankly, I wish it was lower. I think they would do better in terms of AUM. So it's not something I'm happy about, and I can definitely see reasonable people saying, you know what, it's too high. I don't want to pay that kind of an expense ratio and reward that kind of behavior. In my case, I've decided to kind of bite the bullet and buy it. And it passes my criteria for portfolio inclusion because my strategy is I want equity-based assets based on an index like the S&P 500 or the NASDAQ 100. And I want higher income, I want lower volatility, and I'm willing to accept slightly lower total return than the underlying index. So just to give you some comparative data, I compared SPYT to some other ETFs. So I compared it to QDPL, which is an ETF that I like a lot, and it has underperformed by about 76 basis points annualized. Remember, this is under 5 months of data. SCHD, which is a completely different strategy, is just a dividend growth ETF. It's probably my single largest holding, and SPYT has underperformed that by about 48 basis points. SPYI is a pure covered call ETF, meaning It's not a covered call spread strategy. They simply sell calls, and they typically sell calls in the 2 to 5% range out of the money. And it has SPYT has outperformed SPY by about 172 basis points annualized. And then and all three of these ETFs in green, QDPL, SCHD, and SPY are my holdings, are within my portfolio. The last one is not XYLD from Global X, and what they do is they sell at the money calls, which I heartily uh, not recommend, because when you sell at the money calls, you're giving up all the gains. And the data is more and more convincing. In the case of SPYT, it is outperformed over this rather brief period at a run rate of about 288 basis points. So XYLD is definitely bringing up the rear. I have actually got videos on QDPL and SCHD on my channel. You're more than welcome to look at it. So this is basically the bottom line summary of SPYT. You want to own it if income and lower volatility are part of your strategy and you're willing to accept a slightly lower total return than what the S&P 500 would give you. And the S&P 500, as mentioned a couple of times, can be bought through either SPY or through even cheaper ETFs like IVV and VOO. So whenever I look at any ETFs that are based on covered call strategies, I look at multiple aspects that tell you whether the strategy that they are following is a good one or a not so good one. And these are all the things that I recommend one should look at, right? One is, are the calls being sold on the index? And even better, when you sell it on the index, you get better tax, tax treatment. And in the case of SPYT, it does sell and buy calls using SPX, so I'm going to mark that in green. The second thing is the notional value. That is, what percentage of the portfolio have the calls been sold on? So if you can generate your target income and not have 100% of the portfolio in play, that's obviously better. In the case of SPYT, I'm marking it as neutral because they use 100% of the notional, and they use 100% of the notional both on selling a call and on buying a call. So the whole portfolio is in play. The next thing is the moneyness of the call, right? How much out of the money are the calls being sold for? The further out of the money, the better. And the worst possible thing you can do is to be owning an ETF where you're selling at the money calls, because you're giving up all the gains. So in the case of moneyness, because it's a call spread, my assessment is that there is high participation in gains by SPYT, so I'm marking it in green. Then what's the duration of the call, right? The shorter the duration, the better, because the longer the duration and you have sold a call, it helps the buyer of the call and not the seller of the call. So because SPYT sells daily calls, I'm going to mark it as in the green. I like it. I like shorter duration calls. The next thing is, are these trades cash settled so that the underlying asset is being held? This is very, very important. And many investors don't pay attention to this, because what you don't want to be doing is losing the underlying asset and having to then buy it at the new price and resetting everything. So in the case of SPYT, the trades on the SPX are cash settled, and the underlying asset that SPYT holds, which is IVV, gets to participate in market gains. So that's a good thing. The next thing to look at is that, is there net asset value degradation? There are several ETFs, covered call ETFs, that have had to do reverse stock splits because the net asset value went down so much. They were very high yielding, but the net asset value went down. This is something you have to pay very close attention to. So I'm marking it as green because even though it's only been about 4.5 to 5 months, the 52-week spread on the net asset value has been about 13%, and it definitely has passed the bar on net asset value degradation so far. So meaning it is giving the yield that I was hoping for without kind of the underlying asset just melting away. Total return, at the end of the day, total return is what matters, right? You want capital gains plus the income from the options. And so far, it's good. I'm willing to accept in the range of 200 basis points or less underperformance when compared to the SPY, and it has met that. So I'm still marking that as green. The yield is quite frankly the reason that people like me buy such products, and it has been generating its target yield of around 20%. And only time will tell whether it's sustainable, but for the first few months, the distributions have been rather even. The expense ratio, expense is a gravitational force, right? The longer you're up in the air, the stronger the chance that you're going to fall back to the ground because of how gravity works. And expense is the same thing. The way I think about expenses, you've got two ETFs, one with a higher expense ratio. So it's like being in a race where both the race runners have a rucksack on their back, but one guy only has 10 pounds, the other guy has 20 pounds. So the longer you run, and even if the runner with the 20-pound rucksack is stronger, faster, and fitter, time will work against him because he will or she will start tiring out. So expense ratios are rather important, and I'm marking this in red because it's high. I think it's 94 basis points. It's at least 40, 45 basis points too high as far as I'm concerned. And then the tax efficiency. No point in getting very high yield and then giving most of it away. So if it can be qualified dividends, like in the case of SCHD, that's a good thing. If it can be non-destructive return of capital, that's a good thing. And in this case, it is about 80% plus non-destructive ROC. So I'm marking that as green, especially in light of the fact that the net asset value is holding. And then the last piece is qualitative stuff, right? The brand. What is the reputation of the ETF provider? What do you feel about the qualifications of the ETF managers? And how do they come across in interviews? You can learn a lot by what they emphasize, what they don't. And even better, have they invested their own funds into these ETFs? And do you feel that the strategy is one way they're playing the long game, or is it just tactical, right? So I've marked the ETF provider, in this case, the company's Defiance. I don't think of them as highly as I do of either Simplify or Neos, and they have a very wide range of ETFs. So I'm going to mark this as neutral. And the reason for it is that I feel very comfortable with their sub-advisor, Ziga. And the other thing is that the AUM is rather low, and I do want it to grow because the larger it grows, the higher the probability that it will be around. Because I do think the strategy, the underlying strategy of the call spread is a good one. So hopefully you find two things about this slide. One is buying covered call ETFs is not necessarily a simple notion, and you have to look at multiple factors. So that's one. And secondly, SPYT seems to come through this evaluation criteria reasonably well. I practice an investing style called enhanced equity income investing, meaning generating high income from equities. And the portfolio that I have has at least 6 tranches, and I want to make sure that you understand how SPYT fits into the overall portfolio strategy. So very quickly, the tranches are: one tranche is simply owning ETFs that have a history of dividend growth. There's no covered calls or any kind of option on options being used. And I'm giving you several examples from SCHD, VIG, DGRO, DGRW, Noble, so on. And anything in green is in my portfolio. So I own SCHD, which is a very, very large, very successful ETF. So that's coming from the dividend growth tranche. The second tranche is pure covered call. That is the ETFs that sell out of the money calls. And that's very important. They must sell out of the money calls. That's one aspect. And the second is that the underlying assets must be based on some index. The index I love the best is the S&P 500, and I've done a video on why that is the case. But other indexes I'm willing to accept are the NASDAQ 100, and then certain specialized indexes like the Solactive FANG Innovation Index. That's the basis for a ETF called FEPI that I own. And then in some cases like Devo, I'm even willing to accept active management if the track record is good. And Devo's track record has been rather good. So anything that is not italicized like iSpy or SPYI or XDTE are based on the S&P 500. Anything that is italicized like QDTE, IQQQ, QQQI, even JEPQ are based on the NASDAQ 100. And anything underlined is based on either an active strategy or a index like which is not as comprehensive or as broad rather as the S&P 500. The third tranche is covered call variation. In this case, ETFs that sell call spreads. The only two that I'm aware of are SPYT and QQQT. They're both from Defiance. SPYT, which is the focus of this presentation, is based on the S&P 500. QQQT is even newer with a shorter track record and is based on the NASDAQ 100. Then the second variation on covered calls, where there are ETFs now that have come out that are based on individual companies. And I happen to own 5 of these. Goop is based on Google, AMZP is based on Amazon, NFLP is based on Netflix, AAPY is based on Apple, and MSFY is based on Microsoft. So these are all capped at about 1%. But basically, what the strategy here is that the ETF only owns that one stock and sells out of the money calls, and then cash settles it. Then there are futures-based strategies. These are rather new, and QDPL, which is the only example that I have, is probably the ETF that I like the most on this entire page. And this is where you buy dividend futures and you keep the bulk of the assets in the underlying index. So QDPL is based on the S&P 500, and there's a video that I've done on it that explains how it moves with the S&P 500 88% or 87%, and while generating 4 times the dividend income. And then the last tranche is alternatives. SVOL, which is an ETF I like a lot, is basically a short volatility ETF. They short the WIX. It's a mean reversion strategy, and it has worked quite well. And Maxi is from Simplify. They both are from Simplify, SVOL and Maxi. And Maxi holds Bitcoin, and then they generate income using spreads on different ETFs. If it was anybody else other than Simplify, I wouldn't touch it with a 10-foot pole. But the record on Maxi was pretty good. I normally do not like stores of value. I only like equity. But I was influenced by an interview that Lynn Alden did, where she explained how Bitcoin is capped and keeps getting halved every 4 years. So there is a certain demand, and then there's a certain use for cross-border transactions. And quite frankly, the more chaotic the economy, like take Egypt or Brazil or something like that, and cross-border transactions are more and more being done using Bitcoin as the vehicle for the transaction. So in other words, Bitcoin is solving real-world problems. So I've capped SVOL at about 2.5% of the portfolio and Maxi at about 1%. So these are the tranches that make up an enhanced equity income investing portfolio, and this is the model that I use. So now, dear comrades, we come to the end, and this is my interaction with SPYT, the bottom line. First, you must understand that I'm in the living off nest egg phase of my life. I've finished off my working career. I'm living off my nest egg. So that is the basis for all my decisions. And that's something you must keep in mind. So that's the backdrop. My strategy is to generate income from equities and only from equities for the most part, and to not touch the principal. I call my strategy enhanced income from equities. And I mentioned that a couple of times. When it comes to SPYT, it is currently around 3% of my portfolio, and the target is to be at a minimum of 5 to 7.5% range, something like that. I hold it in both my taxable and tax deferred accounts because even in a taxable account, because it's a return of capital, uh, the tax implications are better for me. My position was initiated on very early May of 2024, uh, just a couple of months after it came out. I add to my position regularly, which is how I make purchases on all my holdings. As of August 9th, Friday, last Friday, I have a capital loss around -4%, and the net asset value seems to be holding, and it's within a rather narrow band of around 13% or so. So far so good. And the income has hovered at around 20% annualized. I wasn't expecting it to be able for them to be able to sustain it, but so far so good. I'll be content with a 15%, even 12% return, especially if it's accompanied by return of capital, but it's exceeded that target that I had set for myself. I'm impressed by SPYT's strategy. I think call spreads provide significant optionality because on the days where the markets move up tremendously, the call that you buy helps offset the losses from the call that you have sold. So I like that aspect of it. I believe that SPYT is a viable investment in both investing phases, either when you're accumulating wealth, meaning when you're working in your taxable account. I used to always own income producing assets because I wanted to have some extra cash every month coming in. So I think uh, uh, when I was working, obviously these kind of products like SPYT were not around. But if I were to be at the accumulating wealth stage of my life, I would have no hesitation holding SPYT. And obviously, I'm holding it in my current phase, which is the living off wealth phase, if you will, or the living off nest egg phase. There's a NASDAQ 100 version called QQQT, and I'm also accumulating that. So this is my analysis of SPYT. I like it. I don't like the expense ratio, it's a little bit high, but I like the high distribution, 20% or so. I like the return of capital component because that's tax efficient. I like the consistency of the dividend. It doesn't seem to fluctuate tremendously month over month. And I definitely like the sub-advisor Ziga and people like Jay Pestrichelli who are driving the strategy. So those are the things I value.